Investing emotions in the stock market. Understanding the role of emotions in the financial decisions of investors can go a long way in helping avoid mistakes in stock market transactions. Stock market investors are financially motivated, and it is not uncommon for investors to have strong sentiments about the performance of their stocks. If left unchecked, however, emotions can drive investors to act irrationally or make rush decisions, with substantially detrimental effects on the performance of their portfolios. Here are some investing emotions that would be important to identify, acknowledge, and carefully examine to account for their potential effect on the decisions that stock market investors are likely to face at one point or another, particularly in the case of beginning investors. 1. Unrealistic expectations. Everyone has heard stories about investors who made a sizable fortune through the stock market, and some people may want to replicate those outcomes with their own investments. In practice, however, their returns may be smaller, which may lead to disappointment. 2. Limited patience. Long-term investments are more likely to provide gains than short-term speculation. When the market is down, however, stocks are often regarded with suspicion, and considered to be candidates for selling, even at a loss. In many cases, if investors had simply waited long enough, they would have been able to break even, or sell their stocks for a profit down the road. 3. Loss aversion. For many investors, the losses feel much worse than their gains in the stock market, and therefore may go to great lengths to avoid such losses. The desire to protect oneself against future losses may lead them to sell their stocks low, giving up on the chances of stock recovery. 5. Peer pressure. There is a tendency to agree with the opinion of the majority, even when many investors would not have arrived to the same conclusions on their own. If investors make stock buying decisions based on the results that others have achieved, however, there is a reasonable chance that they may not have the same results, because their circumstances are different. 6. Fear of missing out. One of the most basic rules of investing is to buy low and sell high. However, the fear of missing out on stocks displaying remarkable gains makes many investors buy stocks when their prices are high, before they go even higher, but without considering that in many cases such levels of performance may not be sustainable. 7. Investment regret. Buyer's regret also plays a major role in stock market psychology at times. This issue tends to repeat itself and lead to more regrets, driving investors to abandon their investing strategy and cut their losses before their stocks had a chance to recover. 8. Financial stress. The pressure to reach positive returns on an investment may be felt with particular intensity by those who are increasingly falling behind in their efforts to reach their financial goals, like those burdened by high levels of debt or have already lost money on other investments. This may affect their investment decisions, based on their strong need for positive results. 9. Overreaction tendency. When investors hear news about a company, many of them tend to overreact, based on the belief that the news will have a positive or negative impact on stock prices. This may lead them to execute trades not directly related to the growth potential of a given stock. Financial discipline is therefore crucial to the process of handling investing emotions. Successful investors understand stock market psychology, train themselves to identify their emotional impulses, and handle them with an analytical perspective. Decisions to buy, sell, or hold stocks should be systematically informed by market analyses. Savvy investors will take the time to review their potential trades to ensure consistency with their overall investment strategy. For more information, visit amicala.com.